Genesis Motor was launched with an ambitious mandate. It was meant to prove that a Korean manufacturer could stand shoulder to shoulder with established European and Japanese luxury brands. Design awards, early critical praise, and generous feature lists created the appearance of momentum. Yet as the industry approaches 2026, Genesis increasingly looks like a brand whose strategic costs are outpacing its economic reality. Beneath the polished interiors and confident advertising lies a fragile financial structure defined by persistent losses, limited scale, and a dependence on parent company support that shows no sign of easing. The fundamental problem facing Genesis is that luxury automotive economics are brutally unforgiving. Premium brands require sustained volume, pricing power, and long product cycles that amortize development costs across millions of units. Genesis has none of these advantages. Global sales remain modest relative to competitors, and despite year-over-year growth in certain markets, total volume remains far below the threshold required for self-sustaining profitability. Each vehicle sold carries a heavy burden of fixed costs tied to design studios, bespoke platforms, marketing spend, and dealer incentives. Mounting cash losses are not an accident or a temporary phase, they are structural. Genesis vehicles are often priced aggressively to attract first-time buyers away from entrenched luxury brands. That aggressive pricing compresses margins exactly when the brand should be extracting a premium to justify its positioning. Incentives, subsidized leases, and bundled features inflate unit sales, but they erode contribution margin. The result is a brand that can look successful in showrooms, yet struggles to translate visibility into financial strength. Capital allocation has been another persistent weakness. Genesis has pursued an expansive product strategy that includes sedans, sport utility vehicles, and now a growing lineup of electric models. Each new nameplate requires billions in development and tooling before meaningful revenue appears. For an established luxury brand with decades of retained earnings, this risk can be absorbed. For Genesis, still in its formative years, this expansion magnifies cash burn. Instead of concentrating resources on a narrow range of high-margin flagships, the brand has spread itself thin across segments that demand scale it does not possess. Electric vehicle investment intensifies this pressure. Genesis has committed publicly to electrification timelines that mirror those of much larger rivals. While the strategic logic is understandable, the financial implications are severe. Battery supply contracts, dedicated electric platforms, and software development demand massive upfront spending. At current volumes, Genesis electric models struggle to achieve cost parity with internal combustion counterparts, let alone generate meaningful profit. Price competition in the electric luxury space further undermines margins, forcing the brand to choose between volume and profitability, neither of which currently delivers sustainable returns. Geographic expansion compounds the risk. Genesis has entered Europe and expanded its footprint in North America with bespoke retail concepts and service models. These initiatives enhance brand perception, but they carry heavy operating costs. Standalone showrooms, concierge service offerings, and extended warranties are expensive to maintain. Without dense dealer networks and high throughput, per-unit overhead remains elevated. In several markets, sales volumes are insufficient to cover fixed retail expenses, effectively turning expansion into a loss multiplier. Operationally, Genesis remains heavily dependent on its parent company infrastructure. While this provides short-term stability, it also masks the true economic performance of the brand. Shared platforms, shared powertrains, and centralized procurement reduce apparent costs, but they do not eliminate them. If Genesis were required to stand alone, its cost base would expand dramatically. This dependence raises a critical question for investors and analysts. Is Genesis being built as a profitable enterprise or as a prestige project subsidized indefinitely to elevate corporate image? Dealer network strain is an emerging concern. In some regions, Genesis relies on dual-branded facilities or limited representation that constrains customer reach. In other markets, dealers face thin margins and uncertain long-term returns, reducing their willingness to invest in facilities and staff. Luxury buyers expect a seamless ownership experience. Any degradation in dealer quality directly damages brand equity. Weak throughput and slow inventory turnover further pressure dealers, creating a feedback loop that undermines sales momentum. Residual values offer another revealing metric. Genesis vehicles often depreciate faster than established luxury rivals. This reflects market skepticism about long-term brand strength and resale demand. Lower residuals increase lease costs, forcing Genesis to subsidize financing to remain competitive. These subsidies represent real cash outflows that accumulate quietly over time. While consumers may see attractive monthly payments, the underlying economics grow more fragile with each subsidized contract. From a balance sheet perspective, Genesis does not publish standalone financials, but its performance can be inferred from continued investment requirements and the absence of clear profitability milestones. The brand remains in a phase of heavy cash consumption with no definitive timeline for break-even. As global automotive demand softens and capital markets become less forgiving, tolerance for prolonged loss-making ventures diminishes. What was once framed as patient brand building increasingly resembles an open-ended financial obligation. Strategic optionality is narrowing. Genesis cannot easily retreat from markets without damaging credibility. It cannot sharply raise prices without risking demand. It cannot dramatically cut costs without undermining the very luxury attributes it relies on to differentiate itself. This strategic rigidity is dangerous in an industry undergoing rapid technological and regulatory change. Flexibility is survival currency, and Genesis has limited reserves. Please subscribe to our channel. We want to hit 1,000 subscribers this week. For consumers, the risks surrounding Genesis are subtle but significant. Buying a luxury vehicle is not merely a transaction. It is an expectation of long-term support, stable resale value, and confidence that the brand will remain committed to its products throughout their lifespan. When a manufacturer operates under persistent financial strain, these assumptions deserve closer scrutiny. Warranty coverage and service promises are central to Genesis brand identity. Extended warranties and concierge services are powerful selling points, but they also represent future liabilities. As losses accumulate, pressure inevitably builds to control these costs. This can manifest as stricter warranty interpretations, longer approval times, or reduced generosity in goodwill repairs. Consumers may not notice this immediately, but over years of ownership, friction tends to increase. Parts availability is another concern. Genesis vehicles share some components with mass-market platforms, but many parts are unique to the brand. Low volumes mean limited economies of scale in parts production and inventory. If suppliers prioritize higher volume clients, Genesis owners may face longer repair times and higher costs once vehicles age. For luxury buyers accustomed to convenience, this erosion of service quality can be jarring. Software support is increasingly critical, especially for newer electric and semi-autonomous models. Continuous updates are essential for safety, efficiency, and user experience. A brand under financial pressure may delay or limit software development investment. This risks leaving vehicles technologically stagnant relative to competitors. Over time, outdated software can materially reduce vehicle appeal and resale value. Resale value remains one of the most tangible consumer risks. Market perception can shift rapidly. If confidence in Genesis' long-term viability weakens, depreciation will accelerate regardless of vehicle quality. Higher depreciation effectively raises the true cost of ownership. Consumers attracted by competitive pricing may find that savings at purchase are offset by losses at resale. Dealer stability also affects ownership experience. If underperforming dealers exit the network, remaining locations may become geographically distant or overloaded. Service wait times increase, personal attention declines, and the premium experience that Genesis promises becomes harder to deliver. For owners in less dense markets, this risk is particularly acute. None of these risks imply immediate failure or abandonment. Genesis vehicles today are well-engineered and competitively equipped. The issue is trajectory. Luxury ownership is a long-term relationship between consumer and manufacturer. When that relationship is backed by a brand still searching for financial footing, uncertainty becomes part of the purchase equation. From a forensic financial perspective, Genesis represents an ambitious but fragile experiment. Its success depends on sustained parent company support, favorable market conditions, and flawless execution in an industry that rarely rewards perfection. Consumers considering Genesis should do so with open eyes. The vehicles may impress, but the business behind them remains under strain. Caution is not pessimism. It is a rational response to a luxury brand whose aspirations currently exceed its economic foundation. Please subscribe to our channel. We want to hit 1,000 subscribers this week.